The Nasdaq over the past several trading days, of course, has been getting pretty hammered, and that's primarily related to what's going on with the 10-year yield. And of course, as you can see, the 10-year yield, of course, is rising, and as a result, primarily stocks that exist, growth stocks like Tesla and Apple, etc. A lot of these companies primarily, of course, do very well during low interest rate time periods because they're able to borrow money with very little bit, of course, being dependent upon being paid back, right? So you have a low interest rate, they're able to borrow more money, not having to worry about paying a lot of that money back with interest. So that allows them, in essence, not just many of these well-to-do stocks, like for example, Apple, Facebook, etc. You know, you look at companies like Alibaba or whatever other tech company, maybe Tesla. Many of these companies, of course, are able to utilize this debt to grow their company, but also many of these companies that don't make money are able to utilize a lot of this debt, and they are what is referred to as zombie companies, which you want to be wary of, which is why it's important to pay attention to a company's balance sheets. Now, what we're seeing, of course, in the market is a transition away from tech stocks and more into value plays, typically stocks that do very well, that are, you know, their balance sheet, they're positive on their balance sheets, companies that earn money quarter after quarter, typically dividend paying stocks, and as well as commodities, which I talked fairly heavily about, especially when it came to stocks like, for example, ExxonMobil. And as you can see, ExxonMobil is doing quite well. Even the banking sector, I talked about Wells Fargo. Wells Fargo, another stock that has been doing very well. I've been long Wells Fargo. You can see here, we'll take a look at, I believe I'm long from like $26. As you can see, Wells Fargo, we're currently up almost 1,350 with an average cost of 26.51. So that stock is doing quite well. Got it pretty low, averaged in, and companies looking to go higher. Now, of course, currently we're seeing a little bit of a stall in Wells Fargo, as you can see right here at the $38 mark. We're basically trading in a little bit of a channel between $36 and $38, and I think Wells Fargo and many of these other banks are going to come back into their pre-pandemic prices. And of course, Wells Fargo eventually will go back to paying, you know, that juicy dividend that it paid. Right now, it's only paying, I think, 10 cents, but eventually it'll go back to paying its original dividend once the government allows it to, which shouldn't be too long from now. Wells Fargo are doing quite well. They really don't have a lot of bad assets on their balance sheets, and of course that is as a result of having to basically clean up the books. The government, of course, is holding back Wells Fargo in terms of buybacks and of course dividends, which I think it has done with other banks, but more so with Wells Fargo because of previous scandals as a result. So they've been kind of penalized. But of course, once that penalty is removed, then Wells Fargo will do quite well. So I'll be holding on to this stock for quite some time, obviously for the growth, but primarily, you know, for the return of the dividend. You know, we'll see 51 cents. I think that's what it was paying last time. And then eventually it will creep back up. Very similarly with ExxonMobil over the next couple of years, you know, just like during the Obama era, we will see, you know, oil go to, you know, 75, 80, $100 barrel, gasoline prices going up to, you know, what they were back then, which is like around $5 a barrel. Even in California, we've seen the price of gas already move up above $3 just for regular. And so that's primarily where I put quite a bit of my money. And on my last several videos, I have been talking about food stocks. And so even though the market in terms of a lot of these tech stocks and the Nasdaq have been going down, some people have reported, you know, 15, 20, 30% pullbacks in their portfolio. But as you can see, looking at a lot of these food stocks, they're still doing quite well. And that's basically where over the next probably 2 months, I'll be trying to allocate about 15,000 to these plays between like things like General Mills, Kellogg's, as you can see, I was up on the day, Coca-Cola. So a lot of these value plays that typically pay, you know, 3, 4, maybe even close to 5% in their dividends have a little bit of growth, of course, left in them, as well as, of course, earning a dividend. One that I talked quite a bit about was Tyson Foods. Tyson Foods having a breakout. As you can see, we broke out of $70. We broke out from $70. It does pay a little bit of a dividend, almost 2.5%. But Tyson, of course, has quite a bit of a run ahead of it, being able to move maybe even upwards of 33%, getting back to its pre-pandemic levels. And that's primarily because we're going to see food shortages as a result of supply chain issues, not enough workers. And as a result of not having enough workers, you're going to have, of course, a decrease in production while still maintaining a very high demand, especially as the government, starts handing out stimulus checks. So you're going to see individuals who have money, but of course, because of the large amount of job losses that are going to be sustained as a result of the pandemic, a lot of these commodities, wheat has been going up, soybeans, meat, etc., are going to go higher, which is why I'm investing in a lot of these stocks currently. It's basically my goal for the next 2 months is to try to allocate, like I said, maybe 10-15,000 of my portfolio, could kind of round it out. And taking a look at my portfolio, as you can see, we'll come over here, we'll go to, as you can see on the all, the portfolio holding up quite well for the month, still up 2,800, for the week 1,700, and of course as of Friday we were still up $660, and of course overall we're sitting at 15,000 in gains, and with 1,300 of that in just dividends alone. And this is why I kind of went this route with my portfolio, talking about dividends, the benefits of dividends, having a little bit of cash flow. As you can see for last month, last month for about the month of February, we pulled in about $327 worth of dividends. And so even if I added nothing to my portfolio, I would have $300 that I could basically add, and I could either allocate that into my risk portion, and try to get some capital gains. Maybe I'd do like a quick flip. Maybe I'd see something that would, jump, 15, 20, 30%, and then try to do that again and again and again. Or I could find stocks that pay dividends, that pay basically cash flow, that have the potential to go up, but primarily would basically maintain my principal and then pay me, maybe 5, 6, or upwards of 7%. Like for example, in companies like, for example, Gain at my price point is paying me close to 8%. Obviously, because of the stock price has gone up, as you can see where I was buying it, and of course I've averaged in quite a little bit higher. As you can see, the stock's trading at about $12. I was probably buying this around $7, but then really started to buy it a little more aggressively and averaged up. And of course, with the current price, is paying about 6.74, but I think I have a yield on cost of like 7.25 with just Gain alone. And of course, Gain is a monthly dividend paying stock, as well as Main. Both of these pay dividends, so I'm able to take those dividends. And we'll take a quick look at some of my dividends here. And so as you can see, Wells Fargo, a little bit of a payment, Enbridge, LTC, which is another dividend play, as well as, of course, as you can see right here, Gladstone paying $37.35, and basically looking for the next couple for the rest of this month. As you can see, this is basically where my dividend plays are going to be. I believe for this month it should be around $400 or 4 something for the month. Basically what we're looking for. And as you can see, some of the payments that will be coming in, of course the biggest payment being Exxon Mobil, but we'll get $20 from ORI, some money from Walgreens, Maine, Prudential, IBM, Southern. We have a lot of different food sources, a lot of different companies that we're going to get. Have quite a few monthlies here. As you can see, O is a monthly, Maine is a monthly, Gain is a monthly. Got quite a few of them. LT, I think I have another one. LT, what is it called? LTC, which is another monthly that pays every month. And then of course a lot of ones that are just paying basically quarterly. And so this allows me to track my dividends. I use Dividend, track your dividend dividends.com. And so I'm able to see, as you can see here, for the different months of, how much I'll receive just in dividends alone. And of course, as I start allocating, this month, then it starts to compound these months moving forward. So as I get paid, I get this $360, in this month. And then by the time, between like here or here, it raises this, it starts to compound an inch in all these other months up forward. Or, for example, what is my goal, of course, is to live abroad. And so I can look here at the cost of living. This is basically the world data, which lets you know how much you would need for your monthly income in US dollars to live in all these, of course, different countries. And my goal, of course, is to live in Colombia. And so I can see right here how much I would need at a minimum, excuse me, at a minimum to live in places like Colombia, or of course, any of these other countries, as you can see, where if for whatever reason I was financially impacted in some way, shape, or form, if I couldn't get a job, I could literally live off of my dividend in, basically, I probably say comfortably, probably from any of these countries under 300, right? So any of these countries under 300, I'd be able to live in any of these countries. If for whatever reason I couldn't get a job, etc., and I need a little bit of time, I could go rent an apartment in another country and then basically live off of the dividends and then some of the savings that I have. So this basically helps me to keep my goal in mind. Obviously, I do want more than the minimum, so I'm actually ideally shooting for around between 1,500 and 1,800 in terms of cash flow every month. It's probably going to take me at least, I would say, maybe another 2 years before I reach that mark. I think by the end of 2022, I could be closer to about 1,100 a month in terms of dividends, and that's basically the goal. That's basically the goal for the portfolio. But just basically for this video, just doing a little brief update on the portfolio so people can see where we're at. Even though you're seeing a lot of pullbacks and a lot of these tech stocks, like for example FCEL, which I talked in depthly about. I mean, the sell-offs have been brutal. And so I know that there are quite a lot of people that have been following a lot of these different YouTubers. And if you've been basically, buying the dip, as they say, this one stock alone pulled back 64%, right? And I had warned a lot of investors that if this was the route that you were going to go, that you were playing a very dangerous game. Another stock that I think a lot of people have poured into, which is like NNDM, Nano Dimensions, and again, another stock from the highs of about 18, pulling all the way far back again, roughly about, well, we closed here. So pulled back roughly about 58%. And that's a lot to lose in your portfolio, especially if you're one of these individuals who thinks that these stocks are going to come all the way back up. You really have to look at the chart and see that a lot of these stocks are basically pump and dump. And so unfortunately, a lot of new and young investors get themselves involved in a lot of these stocks and they end up losing their money. They become disgruntled, not understanding why they're losing money. And it's typically because the individuals who they're following are basically utilizing momentum stocks. And that's what these are. These are stocks that are just following momentum, right? They're just following liquidity. And when the liquidity dries up, this is basically what happens, because these companies don't make money, right? As you can see by looking at the earnings, right, earnings per share, that typically these companies don't make money for the most part, right? As you can see, you can look back and you can see this company was reported, their estimate was to lose $1.10, and they only lost 50 cents, right? So most of these companies are what they refer to as zombie companies. They don't make money. They typically just gorge on debt, and especially during periods of low interest rates, a lot of these companies can flourish because they can pay the, they can take out a lot of this debt at very little cost. But again, once the momentum dries up, it's kind of like, what was it, that game, musical chairs, and this is basically what happens, right? The stock is just moving, up and up and up and up and up, and then eventually the music stops, and then whoever's left holding the bag ends up hoping that the stock's going to retrace back up. But unfortunately, this is not the case. I talked similarly about Riot, I think Riot is another one. Pull back very hard from, as you can see, pulling back again upwards of 50%, and you typically lose your money very quickly. What was the other one? Zomedica, another one. Looking from the highs, let's just take 280. Came as far down as $1.40. People losing 40, 50%, 35% of their money. And money of these companies, again, they don't earn money, right? A lot of these companies don't make money. They're just zombie companies that benefit during low interest rates, and then eventually, you know, liquidity finds somewhere to go, and then the stocks they get chased up. It's typically why I stay away from them, because I don't want to see those type of swings in my portfolio. Imagine, you know, if I was heavily into a lot of these stocks, I could lose, you know, 50, 40, you know, maybe even 60% of your portfolio value, and that's devastating, especially if maybe you've accumulated this money over weeks, months, or maybe even several years, and that all gets wiped out via a bad trade, and then you have to rebuild all of that money back, but then you lose also the compounding as a result. And it's why it's important, if you're at least going to follow somebody, to follow someone who is investing in good stocks. These companies earn money. Typically, stocks that pay dividends typically do a lot better during an economic downturn, which is basically where we're at. Tomorrow I'm going to do another video talking about what stocks I will be looking for in the Nasdaq during these pullbacks. I do perceive that the Nasdaq is probably going to pull back another 20% from where we're at, right? So we tested this level right here. As you can see, I typically watch for the level supports and resistances, and we did test this support. More than likely, as you're seeing, we're moving to the upside, so we're testing the resistance of 12.8, and in my opinion, I think that the Nasdaq is going to roll, and we're going to roll all the way down here to about 97, 96, 9800. So talk a little bit more about that in the next video, about what I'm going to be looking for in terms of rounding out the tech portion of my portfolio. I do have a couple of stocks in mind that are tech based, but they also do pay dividends, and so we'll talk about that in my next video. Appreciate you guys watching. If you have any questions, feel free to leave it in the comment section. Feel free to like and subscribe if this is your first time here, so that you don't miss out on future content. And I will check you out. I'll do another video tomorrow about what I'll be watching for the next coming probably months, as I do believe that we will see higher yields in the 10-year, and we still have quite a bit to go. We've got at least another 20% looking at the 10-year. We've got at least another 20% to the upside, so we'll go over to the 10-year, right? So this is where we're at currently, and our next area of resistance is still another 20 or so % away. And so I do believe that we will see rising interest rates, maybe even past 2 cents, which of course will cause the market to trade to the low side, especially a lot of these tech stocks like Tesla, etc. I do think Tesla will come pretty far down. I think a lot of people are overestimating. Tesla, of course, did close below that support, right? So $600 was Tesla support, and it closed below that area. And I think we're going to see a little bit more to the downside, especially if I'm right. We could see another 22%. So we could probably easily see Tesla trade to 400. In my opinion, I wouldn't want to buy Tesla until it's around $200. We might see that, we might not. We'll have to wait and see how the market reacts to the interest rates, and how the Federal Reserve is going to act as interest rates start to rise. Anyway, we're going to leave it here. Thanks very much for watching, and I'll check you out next time.